Good day, everyone. Well, the digital universe is the metaverse, and that represents all online activities, including email, Twitter, Facebook, Zoom, Instagram, TikTok, you name it. You have virtual live audiences, you have socially driven holographic experiences, you have digital land, massive multiplayer online games. And so the metaverse was born essentially with interconnectivity between computers, which enabled users to communicate. And the ARPANET in the 1960s kicked it off, then the PC revolution in the 80s further spurred its growth, and the average time spent online has been doubling every decade. And the metaverse is the beating heart of blockchain. More value is being accrued in digital than physical. Physical is pretty static. And that's why borderless and secure decentralized technologies like Bitcoin will represent the majority of value in the coming years. That's why I made the call I did in 2017 for Bitcoin to eventually reach 1 million in the coming years, then 10 million over the next decade. And the crypto space and the best performing alts such as Ethereum should reach valuations in the tens of trillions of dollars, since a $1 million Bitcoin implies a Bitcoin valuation of $20 trillion. Once the bear market is over and we get a major crypto buy signal, expect the crypto picks list to repopulate. Now, in addition to being an incorruptible store of value, Bitcoin also reduces the attack surface between countries because Bitcoin is not physical. So the hot wars of standard history involving tanks, planes, and bombs will become less economically attractive to countries. Bitcoin thus minimizes the global nuclear threat, and I wrote about that in a prior article. Now, the Internet revolution has continued to rapidly spread across the planet. In 2010, we just had about 2 billion people connected to the Internet. Now we're at 5 billion, and by 2030, we'll probably be at around 7.5 billion. The exponential advancement of AI is spawning an intelligent brain for the entire planet as humans become increasingly cybernetic. By this, I mean we depend on AI on a regular basis. So, for example, AI figures out our likes and dislikes on Spotify, on Amazon, YouTube, Twitter. The utility of AI together with blockchain catalyzes the growth in the metaverse. Bitcoin and the metaverse's largest opponent is government, and that would be government-controlled mainstream media, which uses fear-mongering tactics to scare the public. So it pushes lawmakers into passing hasty laws based on often bad science. Bitcoin has been badly victimized, on which I wrote extensively. Many uneconomic proposals have been passed into law to reduce the carbon footprint, to minimize nuclear power, and minimize nuclear power. So it's a double whammy. And this negatively impacts the global GDP, which in turn negatively impacts research and development, which in turn slows progress and postpones any breakthroughs in clean energy or carbon reduction technology. And this is problematic, assuming part of the rise in the temperature of the planet is caused by carbon emissions. No one should be astonished at the Luddite movement to curtail energy use, given the constant FUD spread by MSM on the dangers of global warming. As a consequence, economically viable technologies such as nuclear power, which carries its own special set of MSM FUD, are relegated to the back burners. Nuclear power is superior to fossil fuels, which are superior to many alternative sources of energy, because many of these alternative sources remain uneconomic. But this does not stop lawmakers from embracing them because of a misinformed public. In reality, human beings are incredibly inventive. They rise to the occasion in every crisis. If you take, for one of many examples, like acid rain, when once upon a time it was seen as the most dire environmental threat for the planet back in the 20th century, in 1982, Canada's Minister of the Environment said, quote, "Acid rain is one of the most devastating forms of pollution imaginable, an insidious malaria of the biosphere," unquote. It was widely believed forests would be decimated, but a few decades passed and forests were healthier than ever, taken as an aggregate. And on other fronts where acid rain could create issues, the adoption of catalytic converters for automobiles reduced sulfur dioxide emission from 31 million tons in 1970 to just 1.8 million tons in 2021. Global warming is a little different. Long-term trends out to centuries have shown the planet goes through very long cycles of warming, then cooling. Earth has experienced cold periods or ice ages and warm periods or interglacials on roughly very long year cycles. And this has been true for the last million years or so. This rise in carbon emissions is only a small part of the change in the Earth's temperature. So in other words, the Earth is still going to continue to warm, even with economically crippling laws that reduce carbon emissions. Humanity, sadly, has a horrid track record when it comes to being manipulated by fear. Cognitive biases spawned by an aversion to loss, as well as evolutionary psychology, are the core of the problem. Loss feels worse than the equivalent gain. Further, the masses on balance tend to be more pessimistic than optimistic, even though the hard data shows we are far better off today than in any prior century in terms of average living standards and work hours. Largely vanquished is the ubiquitous slave trade of earlier centuries. Average life expectancy and infant mortality rate have massively improved. So efficiencies only dreamed of in prior centuries are increasingly common today, even in third world countries. Now, as computers become more powerful, the demands on energy increase. Electricity consumed by digital devices and infrastructures is growing at 7% per year, while global demands on electricity is growing at 3% per year. The number of PCs nearly doubled between 2008 and 2015. There's nearly 9 billion active mobile phones. It currently takes 70 billion kilowatt hours a year to run the internet. And in consequence, the exponentially growing metaverse will become increasingly energy intensive. The metaverse may be worth 800 billion by 2024, partly due to a surge in online interest during the pandemic, and that's up from a small 47 billion in 2020. The global AR, VR, and MR markets will reach roughly 300 billion by 2024, and in 2020, the mobile AR market was worth nearly 7 billion. By 2025, it should reach over 26 billion. Now, the rate of growth is threatened by enactment of laws based on bad science. The reality is that crypto does things far more efficiently than prior technologies. The metaverse diligently expresses these efficiencies. With greater efficiency comes greater growth, so with greater growth comes greater wealth creation. And so you get faster advancements in technologies. And crises are not born overnight. Any major crisis gives plenty of warning signs to which humanity will be far better equipped to quash, given the advancements made in cutting-edge tech. Now, over in markets, as we warned, major averages in cryptocurrencies are rolling back over as the Fed is intent on hiking rates to a target range of 350 to 375 bips. The CME Fed futures is, well, last I looked, it's pricing in 250 basis point rate hikes and 125 rate hike. And that brings it to 350 to 375 by the end of the year. Given record levels of debt and growing delinquencies, markets won't stand for hikes beyond such levels, but may even retest lows before then. The Fed chair has room to hike, given the extent of the dead bat bounce, so he may get to this 350, 375 range before he has to calm markets by saying he will no longer tighten the balance sheet. That is, he will put rate hikes on hold, much as he did in December 2018, just after the Christmas crash. Gil, how are you seeing everything?
Well, I thought the market was short last week when the S&P ran into the 200-day line, and so you've come off. Today you have a little blip ahead of tomorrow's, what is it? What is the event?
Well, we have Jackson.
Pardon me?
Jackson Hole.
Yeah,
Jackson Hole's Friday.
And I expect they'll be pretty hawkish. And this whole bear market rally has been predicated upon the idea that they've controlled inflation, they've licked inflation, they're going to start lowering interest rates again. But you know, I don't really see it happening at all. You can see inflation is still running pretty hot. It was the gasoline number the last time around that knocked things down, but everything else continues to go up. So I've noticed that at the stores, things that I buy on a regular basis, and my basket of goods continues to rise. And I was shocked at some price increases. But here we see, I mean, you can see what's going on today. You got a little blip. They got everybody buying the market because In other words, as I like to put it, they got the fish biting because you had the worst drop in housing prices since 2011, and also the durable goods number was eh. So they're trying to push things on that basis because there's still that hope. But when you look at what's going on right now, you're underneath the 20-day on the S&P and the Nasdaq, and you're just bumping around. Looks like a little bear flag. That's all it looks like to me. But I think you could get you could be up small today. That would make sense within the overall context of the move off the highs. And we'll see where we go from here. But to me, not a market to be doing much other than swing trading and shorting. I mean, even shorting becomes a swing trading activity based on the volatility that we're seeing. So funny you should talk about nuclear power, because this also shows you why this market is confounding. I mean, our premise has been, as Chris pointed out, that you're going to see countries adopt nuclear power. It may not happen right away, but it's going to happen over time. So we like this name right here when you had a very subtle pocket pivot right there. And then what happens? 3 days later, it busts the 200-day line. That becomes a short right there. It undercuts this low here. And now you're jacking back to higher highs on news that Japan is considering or aiming to restart their nuclear power program. I guess what did they shut down? Fukushima got shut down after the earthquake, 10, 12 years ago. When was that? That was a long time ago, but I don't think they've restarted that.
2011.
What's that?
2011.
Yeah, so it's 11 years ago. So, I don't know. They got this thing running, but what you'll notice, and this is very typical of this market, I think you get a lot of retail call buying. And so I can see that the call volume is pretty high on this thing. And the retail money will come in and start buying calls and start driving things to the upside like crazy. And that's why you'll get moves like you see back here, where you're jacking to the upside on huge volume. But where does it go? It goes nowhere. So I'd be wary of this move, although I have to tell you, I wish I had bought this undercut and rally down here. And I guess you could have bought it as a bottom fishing type of viable gap up, but that's not really the type of position that we really look for. So, but very interesting, because our thesis has been that nuclear power will gain favor over time as governments realize that they can't. Solar isn't going to do it, and neither are electric vehicles. That's all sort of absurd. And with all of the blackouts and the brownouts and everything else in Europe and also around here, it's likely to continue. So we like this name, but look at the way it plays out technically. It'll drive you batty. So that's the challenge of this market right now. So I don't think it's a trend followers market. I don't think you're in a confirmed uptrend. In fact, if we look at the S&P going all the way back to January, all you see is that we've essentially, let's see if I can fit this all in here. Here we go. We've essentially rallied up to this downward trend line, and that's basically what you did in the 200-day line on the S&P. So everybody was talking about, the S&P has retraced 50%, and anytime it's done that, it's never gone back to the lows since 1950. But people who cite that fact, I think, are pretty stupid. In my usual blunt manner, I'll say it. I think they're stupid because they're not taking into account the fact that things are a lot different now. And what happens is you'll get a handful of stocks driving a move. So Apple, Amazon, Microsoft, and Tesla have driven the S&P's move off the bottom, accounting for 30% of it. Okay, so we get this retracement, but yeah, it's being driven by a handful of big stock names. And so it's a lot different than it has been historically. So to try to make a apples to apples comparison is kind of absurd. And then of course there's the Nasdaq, which has not posted a 50% retracement, but in past bear markets, we've seen it post a 50% retracement and then blow up, right, Chris? Like in 2000. Yeah. So, so I don't understand what these people are talking about. It just seems kind of stupid to me, but that's a lot of people are talking their book too. I saw, what's his name? Ken Fisher, or is that I'm thinking of the guy? He sits there with his hands looking like he's fondling two large spherical objects in front of him that are invisible to us, but apparently he can see them. And he sits there and talks about this, and he's a fee-based manager, so of course he's got to have people coming in all the time to feed his business. And I think that's basically what that's all about. So I wouldn't rely on that. I would just watch the stocks. And of course, what we saw the other day, let me clean up this mess here with all these charts. See if I can get this guy to behave. No, he doesn't want to do it. Come on now. Get him over here, and actually it could be a her, I don't know. We'll have to ask these charts what their pronouns are, but if you look at, I'm going to go to my HES investor, and we'll look at Ponzi stocks. So if you look at Infinite Peace, like they're all up today. Some of them are going nuts. You got Peloton, but they've been rolling over the past few days. So they did that. I don't know what Peloton is running on right now. But you can see stuff like ChargePoint, which was rallying after Senator Joe Manchin jumped over and put through his support behind the new Inflation Reduction Act, which they're also calling a climate bill. I don't know what the hell that means, but now some of these are rallying back. They could be pushing into shortable areas like ChargePoint up into the 200-day line, Sunrun into the 10-day, Blink into the 200-day line. Some of these are just so far down there it doesn't really matter anymore, but you can see that they rolled over last week and they all blew up. Let's see, we got the Dow running 126 points. Now, what happened? Did the Fed say that they're going to lower interest rates? Rivian bouncing off the 50-day line. So you can see all of these Infinite P names that were coming up off the lows, and of course everybody was getting excited. They're running out of gas, and so now they're rallying. So just kind of watching them to see what shakes at this point. But I think you're still in a bear market rally, and we'll get a sense of things probably tomorrow when they have the Jackson Hole, Wyoming Fed meeting, where all the elites get to go hang
Friday.
out. What's that?
That should be, I believe, Friday. Yeah, that's on a Friday. Tomorrow we have the unemployment, or not the unemployment, but the jobless claims. And then on Friday we have the PCE, which the Fed uses, and then we have the Jackson Hole.
Okay, so that's what we've got. And so we'll get a better picture, but I don't think the Fed is going to ease up. Yesterday there were some Fed heads out saying that they're going to they want to raise 100 bips in the next meeting. So we'll see how that one plays out. But
actually,
anyways.
most of the Fed members, there's a site I was on. I don't remember what it was, but you can Google for it. And it just shows you where on the spectrum each Fed member is between dovish and hawkish. They're pretty much all on the extreme hawkish or one degree off extreme hawkish. So I think we got higher rates coming. I think that the Fed's going to be extremely stubborn in getting the rate, the target range up to 350 to 375 by the end of the year, which means that markets are in for really rough sledding. I mean, this seems to me pretty predictable. I mean, you don't get moments in history where things come together this well. I mean, I would say at the beginning of the year, it was pretty much a no-brainer. I mean, we have time-stamped records and trading records showing that we're either shorting or going to cash, and that's played out very well. I just don't see an end to this downtrend yet. The only thing that can spark the end is if the Fed surprised the markets and said, "Hey, we're going to put rate hikes on hold." I don't see how that's possible, given the hawkish tone of pretty much every Fed member.
Yeah. So, and I think the stock setups are showing you, because I mean, last week they nudged me to the short side, and then the last few days have been very nice on the short side. You get a little bit stretched to the downside, and today you get a nice little reaction rally. So now it's a question of where to set up again, if in fact that's what one wants to do. But to me, all these names came down and got chopped up. And now they're bouncing today. Semiconductors have been coming down. Of course, they had a nice move off the top. I'm looking at these are the biggest names among the semiconductors that make up a good portion of the semiconductor ETFs that are out there. And you can see these are down here. So they're all in position, in my view, to rally. So I'm watching the rallies and I'm trying to figure out what I might want to short into, if at all. So I have to admit, I find this, it's got a short entry trigger on this one, CCJ. Here you see the cross right there on the MACD that just occurred up here at about 2660, so 2655, something like that, and it's coming in now. See, the other thing about this, you get this phenomenon in this market, as I showed you, where some news triggers a big move, and then the retail public comes in and they start buying calls, and if they're picking on one or two stocks, like they were on Bed Bath & Beyond a couple of weeks ago, or maybe it was just last week, and then it evaporates, and or some news comes out, and then the companies are starting to take advantage of this, like AMC. Look at that blow up. So that thing's just gotten chopped up into little pieces. But they can briefly jack them, okay, because they all pile in on the calls. It forces the market makers to buy stock to hedge. And then what'll generally happen is you get an air pocket below it. So I'd watch this one, even though I think longer term I like this name on a fundamental basis, on a thematic basis, but I don't think that I want to play exactly right now in terms of the long side. I mean, I wish I gotten long this morning at the open. Now I'm kind of looking at it as a short into the move, because we've seen before when you get these big jacks, then it will suddenly give way. So anyways, no questions I noticed, but let's go back and look at some of the semis. So you can see where they are. They've all come down. Texas Instruments failed, the little double top a couple weeks ago. Western Digital runs into resistance along these highs and it rolls over. So, and you can see the general picture here. And basically what you have are breakdowns over the last week or so off the peaks, off of these nice rallies off the lows. And so now we're coming in and we'll see where they find support, if at all. So I think it's just really an open question at this point. You had retail going last week, I guess, on what the Home Depot number was. Let's look at some of these. But again, same situation. You see how you get a nice jack and CarMax, but then it blows up. These guys are going to have problems too, because the auto loan market is going to blow up, because they did the same thing that they did with mortgages back in 2008. And basically, because people didn't have to pay rent, because people didn't have to pay loans or mortgages or anything, they had all this money, and you get the PPP stuff going on. And so people bought cars, and you've got a lot of loans where you have someone, say, with making minimum wage, but they were able to get a $40,000 car loan on an expensive car, and they're not making their payments. And so what now has happened, and I'll reference an interview on my Twitter page. You can go check that out and see if you can find or look at that interview with Danielle DiMartino Booth. Interviewed a guy who's considered an expert in the industry, a major player in the industry. And what he's seeing is that suddenly loan delinquencies in the auto loan sector are spiking. But interestingly, he would expect, because he's also a repo guy, okay, he would expect that if you see a spike like that, then you would see a spike in repos. But you're not seeing that. And so what that tells him is that the banks are sitting on the loans, because they don't, like with the mortgages, they don't want to have to value them below their cost. And so, in other words, take the losses on their books. But at some point, they're going to have to. And he sees that coming to full fruition in 6 to 8 months. We'll see how that plays out. But I don't know. Are you in the market for? Oh, you don't drive a car anymore, right? I could be in the market for a new car in a year. So we'll see what happens. So in any case, that's something to keep an eye on. Here's a question somebody's asking. My entire Twitter feeds, literally every other post, have been talking about Celsius Holdings and how great it is, and a true market leader since yesterday. From your decades of experience, do market leaders of the previous cycles become that obvious to everyone? Well, let's take a look at it. Get a little bit bigger here. This one is actually, it broke out, but here's the thing. It's actually a big, giant punch bowl. See that? So I'm watching this. I don't think I would buy it up here, but I do think that if it drops below this 110.22 left side peak, I think it could become shortable. Look at that CCJ coming in. I am short it now. That's coming in. And again, see, this is what I'm looking for, is just suddenly you get an air pocket underneath it, and it just comes in very rapidly, so it's a one-day wonder trade. In any case, I don't know what you mean by your question. Do market leaders of the previous cycles that obvious to everyone? Maybe because it is obvious to everyone, it's going to fail. So I certainly wouldn't be buying this as a new breakout. The base is pretty sloppy to me, and it could potentially play out as a punch bowl of death if it eventually busts back below this 110.22 low, or is it 110.12? Let me take a look. 110.22, and then confirms that by busting the 10-day and the 20-day. That would make it a pod. Okay, everybody gets hung up. Like I've gotten some emails from people, oh, is Celsius Holdings a pod? Well, it's not a pod until it fails. For now, it's a big punch bowl. And you can go back and you can look at Cisco, I think in 94. I think you can corroborate this for me, Chris. Cisco had a 50% deep cup. Then it formed a handle, but the handle didn't last, 3 weeks and it took off. It took about 13 weeks for it to set up and go higher. If you go look at 2008, First Solar formed a punch bowl formation and it broke out. It's actually doing that again. Notice that? And here we come back up to the high. But if we go back to 2008, you can see that here's where it had. Let me back this up. And here you can see the punch bowl formation. So it's a 50% deep cup. It runs straight out to new highs. So this is kind of what Celsius is doing right now, in my view. And of course, it gives you a couple, 3 moves to the upside that breaks down and chops around for a long time. And then it blows apart when? Well, it blows apart when the market blows apart. And it came apart pretty nicely. So in my view, this is probably what Celsius is. So I definitely wouldn't be buying it here, but I would monitor it for a possible punch bowl of death type of short sale situation, or just a simple double top if it comes back below that 110.22 level. Good question. Thank you for that. We were able to cover some other stuff, because you do have a punch bowl formation in First Solar. It is not a pod, I will remind you, because it has not busted the 10-day and the 20-day. I want to see if they... I went bonkers on this thing. I shorted 12,000 shares of CCJ. We'll see if this works. It's coming in fast. Look at that. But here we're coming. Okay, if we look at this now, let's take you into this in real time. You see how you're coming down to the 20 period line? Okay, so that is at, I need my data window. Here we go. Okay, that 20 period line is at 2612. So as we come in, if I go in heavy at what I consider the inflection point, then what I want to do here is possibly trim it as it comes into the 20 period. So I'm going to do that. I drop it down 11.5, 11,000, 10.5, 10,000 now. Okay, so now I'm working that. So we'll see what happens here at the 20 period line. It may bounce and then roll, or it may just bust right through it. And of course, now that I covered 2,500 shares of it, it's probably going to, just to piss me off, because I like getting really heavy and then watching things blow up. In any case, where are we? What were we talking about? Oh yeah, retail names. Let's go back. Well, I want to, what I want to cover real quick? Let's do this. Not all securities. Let's go to the solars. We were just looking at those a second ago. But you look at names like Array is coming up towards a double top. But in this position, it almost feels like it could be a short right here at the 10 DMA here. So I don't know. We'll see how that goes. But looking around, Canadian Solar trying to break out. That one's a Chinese name. Enphase. Now, this is another one that could potentially play out as a punch bowl of death. But so far, it is holding up. I think there's a 282.46 peak on the left side. You did break that on Monday. Now you're pushing back above it. So we'll see what happens from here. I'm not really clear, but as I showed you with that First Solar example from 2008, they can hang around here for a little while. So that they don't. Everybody gets excited because they want to call it a pod, and of course, it's like the high tide flag. They think that if you can slap a label on it, then somehow that means that it's magically going to produce huge gains. It may not. You really have to pay attention to what it's doing where the rubber meets the road, which is where you have the daily price action along the 10 and the 20, and also the left side peak that might trigger a short sale entry. And it may turn out to be just a tactical entry that makes you say 10, 15% very quickly, and then it rallies again, and then you try to come back into it. So you don't necessarily just sit there because you think you can label it as a pod. But that's one name in the group. You see, we already covered First Solar, but you see Solar Edge. That was a double top here, and that's blowing up. Now it's trying to bounce off the 200-day line. That's a later stage failed base. So we'll see how this one plays out. You see how now we get the CCJ 2627. So you see how that comes up off the 20 period line right there? Okay. So eventually I want to see it. Now I'm watching the 6-period line. I don't want to see it get back above that. That should be near-term resistance if this is going to break from here. Not clear right now. I mean, it's a fluid situation, so I think you got to be you treat it fluidly. But I'm in there, and here we come. Okay, so now we're pushing down to the 20-period line. We'll see how this plays out. Isn't this exciting? I can feel the adrenaline just coursing through my blood. Anyways, where were we? Oh yeah. Let's get back over here. Any other questions? That was a good question, Stella. Thank you for that. Sun run, a double top here through this high. Let's blow this up a little bit. Whoop. Well, you know what? Let's make this chart a little bit longer. So you did see how you have this left side peak here. And I think that was at 34.34, and you busted it on Monday, but then you rally above it. You bounce off the 200-day line here. Let's clean this mess up. You have the 200-day line here. You bounce off of that, and then you push up towards the 10-day line again. So you see how this is pretty volatile. So if you're trying to campaign this on the short side or work it short, when it drops below this left side peak, you get the cover point at the 200-day line. Now you're bouncing. Now you're kind of watching to see where this thing goes. I don't know if I'd be in a big hurry. Maybe wait till tomorrow. So anyways, getting back to retail, because retail has been kind of an interesting group, mainly because they had everything rallying. So let's look at a few of these. So we just fly through a few. So you can see here, Amazon is short at the 200-day line, the mother of all online retailers. But you'll see these are all the same. You know, they ran up last week and they've rolled over since and blown up in some cases. Crocs still trying to hang in there, but that's really neither here nor there. But some of these are in positions where it's possible that they could play out as short sale entries into rallies after breaking. But you can see most of them topped last week and they've come in. The one that I was watching, here's McDonald's. Okay, it's not a punch bowl because it's not 50% deep. It's just a base. You broke out. Now you're flopping around the 20-day line. Will this fail as a later stage failed base type of setup? That's a possibility. I was also watching, I think I even mentioned these last week, Home Depot right into the 200-day line was a short, and then it's rolled over. Now you're bouncing off the 65-day exponential, it looks like. Also, Lowe's, same exact sort of setup. They run into the 200-day line after earnings like Home Depot, and then they roll off. So that becomes a short there. I think Walmart was another one that was running. And that, you see how these all look exactly the same? Walmart right into the 200-day line. I think that was after earnings. Correct me if I'm wrong. And there you go. You know, so very interesting. In any case, those have worked out as short. So my point is simply that, yeah, the short setups were there last week and they worked. So the market nudged me towards the short side, but a lot of that gets covered on the way down as it pushes down to potential moving average support or other reference areas. Like even the CCJ, if you look at that, you know, if you were long that, you could have flipped short on this day, which is quite possible. And then you cover here on this undercut and rally, but then you could have gone long. But that's tough to do because you wonder what's all the volume here, you know, because it was a lot of selling, and why exactly is that happening? I think, though, initially the idea that there's going to be huge money to be made selling uranium that's already difficult to mine. I think there's going to be room for more players, but we'll see how this plays out. Right now, here you are at the highs of the range, so I'm obviously not going to buy it here. So, and it is coming in, but now we're holding along that 20-period line. So any other questions? What else? What other exciting groups are there? Ags. Let's look at fertilizers. Been trying to rally. Here's Agco trying to push through the 50-day line, I think that was. Yeah, also the 10-day line and the 20 is in there. Here's Bungie trying to push through the 200-day line where it's finding support. CF Industries now trying to push into new high ground, but not quite there. If it closes up here, it'll be a new high close. But we'll see how that goes. I mean, they got these guys running yesterday. Corteva's another one. Deere is pushing higher, but you can see all of these positions are down deep in the base. But IPI, Intrepid Potash, posted a pocket pivot at the 50-day line yesterday. Not necessarily something I would want to buy after the fact. Mosaic posted a pocket pivot here, and that would have been Monday when the market was getting clocked. And Nutrien posting a pocket pivot at the 10-day line yesterday. So, this group is acting well. I just don't know how much juice it has in it. And you look at airlines have all gotten whacked, but they're trying to bounce off the lows. So, it's touch and go, a little this, a little that today. Kind of waiting to see what the Fed has to say or what Powell has to say at the Jackson Hole, Wyoming meeting. What else? Let's look at, we can look at big stock NASDAQ names real quickly, because the ones that have been pushing the rally, not Google, okay, but Amazon is one of them, but it's starting to give way. Apple is the other one. And notice how you get this sort of double top thing going on where it runs up to the prior highs. Now it's backing down to the 20-day line. We'll see if it can hold support there. Booking Holdings runs down from the 200-day line. You can see that. Cisco gaps up on earnings, and that's a short. And now it's coming to fill the gap. Intel heading lower lows. Meta Platforms. Supposedly they're going to capitalize on the metaverse. Doesn't look like they're doing a very good job of it. Microsoft rolling over after being a short at the 200-day line, just like Amazon, but that's another one of the names that has been responsible for 30% of the S&P's move off the lows. NVIDIA and Oracle is short at the 200-day line last week. Qualcomm similar, but more on the break at the 20-day line. It was a short at the 200-day line about a month ago. So, it's all pretty clear what's going on here. You break off the peak, so we may be setting up for a new leg down. That's a possibility. Or we could just chop around. I do remember in 2008, there were two rallies, one in the spring, and then that rolled over, I think, in July and bottomed and then went back up to the highs in a double top. Let me go back. Let's look at that. Whoop. So here's the top in October 07. Yeah, you basically had, let's see if I got this right, 2108, 208. So you had this, no, I guess I'm not, let's see this. We'll look at the NASDAQ. I guess it's in the NASDAQ where it happened. Yeah, so here's where you broke off the high in October, and then you broke down, you bottomed, you had one rally here, okay, and then you rolled over, and then you had one more rally back up to the 200-day line, almost like a double top, and then it blew apart. So you could do something like that. There's any variety of outcomes that could occur, so you have no idea. Also, and Chris, you can chime in on this if you want, but I remember that in 2000, the Fed was lowering rates after the market broke down. In 2008, the Fed was lowering rates as the market broke down. In 2022, the Fed is raising rates as the market breaks down. And as somebody said, if the Fed has to start lowering rates again and everybody's banking a rally or a new bull market on that possibility, they're forgetting the fact that if that happens, then that tells you things are really screwed up. And people don't understand that in a recession, in a deep recession, that will dry up liquidity. And that can have a deleterious effect on the markets. So, I think
actually in 2008, they kept hiking rates. 2007, 2008, 2017, 2018, they were hiking rates, and then the markets just started into this really fast downtrend in October, all the way down to the Christmas crash in December.
Right.
When they then reversed course. Well, that's when Powell came on live and said that they won't be tightening the balance sheet anymore. So that was the signal to the market. Everything's going to get put on hold. And then I think it was just a couple weeks later that he said that they would actually start to print money again.
Right.
So they did a full about face by January of
A couple of
2019.
questions before we wrap it up. Someone's asking about Store Capital. It's a REIT. So what do you want me to tell you about it? I don't buy REITs. You know, basically a REIT is a interest rate substitute, and the TNX is up to 3.098 today. So why would you want to buy this? And I don't really see anything in the pattern that gets me excited. It looked like it was a short over a week ago, but that's it. So I don't know if you have some other insight on this, but I don't really understand what the point is. Unless you think the Fed's going to start lowering rates, then you need to buy this because interest rates are going to go down and REITs rise as interest rates drop. So I don't know. So that's basically that. But, you know, that's basically the situation. You're watching some of these names as they rally. Possibly they become shorts. Possibly they don't. Maybe we chop around for another week or so, but we are pushing into the end of the summer in the typically weak period of September, October. And that was when the market blew up in the summer of 2000, or after the bear market rally, the summer of 2000, and also the spring-summer bear market rallies of 2008. So we'll see how this plays out. But that's really all I have. I mean, I don't have a lot to do. I'm showing you guys a couple things here. We go back to this guy. You see how he's trying to hold the 20-period line here, but can't really get back above the 6-period. So kind of interesting. We'll see how this goes. But you do have the cross. You got all the call buyers coming in. In fact, if I look at my Camco options alert, September 30 calls sweep near the ask. So they're just eating them up, you know, and that drives the stock higher. And that's why you get these one-day wonder rallies. But I think some of these one-day wonder rallies can also present interesting short sale opportunities if you can handle it. PayPal looks weak at the 20-day line. Let's look at that. I don't know. I don't see anything here that really gets my blood boiling. So it's above the 20-day line. So it's actually holding support at the 20-day line. So not clear to me why it looks weak. But, you know, this is another one of these names that's been beaten down. PayPal also is considered to be one of the four horsemen of value stocks now. Okay. But, you know, what is that? That's not much anything. So I don't see anything weak about it. It is one of the four horsemen of these new value stocks in the Russell Value Index. The others being Zoom, which it went lower yesterday, so much for value. Meta Platforms, formerly Facebook, that just keeps getting whacked. And then what's the fourth one? Oh, Netflix. Yeah, here's a deal, though. When you have stocks that have been big PE expansion names that have gone up on PE expansions over time, and they're growth names, and then suddenly they become value names, that tells you something is very wrong, because all of a sudden the market had been previously valuing their forward earnings stream very highly, and now all of a sudden they're valuing it very low, and that's telling you something's wrong. So, you know, to think they're value stocks, you buy them and you're going to make money, I think is a bunch of BS. So anyways, that's all I've got. Let's wrap it up. You got anything else, Chris?
Just that we've come pretty sharply off the top in this rollover, and I think the rally we're seeing today is just it's just an oversold rally. So if you look at if you look at the Nasdaq back from, I guess, April, May, June, where it got clobbered, it doesn't go down in a straight line. It goes down fast and then it bounces, goes down, bounces, goes down. So I think we're we seeing a little bounce here wouldn't be surprising whatsoever. But on the other hand, we've got the Friday Jackson Hole, so I think the market's pretty cautious about that and on tenterhooks. So we maybe go down faster and further. We'll see.
All right. Well, thanks for showing up, everyone. We will catch you next week. Enjoy the rest of the trading week. It should be exciting. We'll see how it plays out.
So long, everyone.